The move we saw this week in the bond market, yields up by 40 to 50 basis points on a 10-year and 30-year maturity. The dollar down by close to 3%. Everyone's got the same question. Evidence of bond trades blowing up, or are you starting to see people distance themselves from dollar assets?
I think that's a great question. From our perspective, we're seeing a complete deleveraging of positions, and that's what's been driving it. So whether it's been swap spread trades, whether it's been the Treasury basis, whether it's been investors who sold Germany and bought the U.S., all those things have begun to unwind, and it's put a lot of downward pressure on Treasury prices. Two things happened at the end of the last week that make me feel a lot more positive this week than going into last week. The first is Susan Collins came out and broke from the Fed's grip of the only thing we're watching is inflation, and talked about we'll be prepared, we're watching the market, if we need to step in, we'll step in. The other thing that we saw was the Fed report that showed that actually foreign central banks and reserve managers weren't selling treasuries, as was widely rumored. They actually even added a little bit. And in our conversations with overseas investors, they're not being shaken out of treasuries.
If that's the case, then how concerning would it be to you if treasuries didn't rally this week?
I think there's still a bit more of a washout to go. I think there are still the investors that are coming in overseas that have seen the downward price moves and may be unwinding some positions. But I feel pretty good that we're putting in a low in price and a high in yield here.